Not knowing these secrets could cost you access to hundreds of thousands of dollars. In this video, we're going to be breaking down some tips for property investors so you can streamline your property portfolio, get the most out of your cash flow, and build a multi-million dollar property portfolio. So let's not waste any time and dive into these tips. What I'm hearing a lot when it comes to making a property purchase is people struggling with brokers and banks and using their equity and accessing serviceability to draw down cash from the bank. Banks are saying, yeah, you've got plenty of a deposit, but that deposit is not going to get you $1 million. You might have a $200,000 deposit, which represents 20% on a $1 million property, but we're going to only give you $600,000. And the reason that is people don't have the serviceability. Whether it's your day job income or you and your partner's day job incomes together, the banks are using a 3% buffer when it comes to assessing your ability to repay loans. What this means in layman's terms is the bank is assessing you at a much higher rate and seeing if you can make these repayments. Now, with the cash rate moving at around that 3 to 3.5% mark, this means people are being assessed on a 9% interest rate. And you might say, how did you get there, Luke? Well, the banks typically have a 2 to 3% margin on the cash rate. So if the RBA's cash rate is at 3% and the bank is providing debt at 6%, when they test you for your serviceability, the main APRA regulated banks are going to be assessing you at 9%, 3% above their standard variable rate. What this means is it's very difficult for people who even have the deposit to access debt in large quantities. And this is why we've seen a pullback in property prices the last 6 months. So Luke, you've told me the problem. What's the solution? Well, there's really 3 levers you can pull here. You can either increase your income, reduce your expenses, or have a chat with another lender. So option 1 is increase your income. That means you need to go to your boss and ask for a pay rise. Make sure the banks are picking up all of your rental income and any side income as well. And if you want to, you could go in with a partner who you're investing with over the long term. This is what Emily and I have done. We were both on 6-figure salaries. We both were in managerial type roles. And when we dealt with the banks, we had a large combined income, which allowed us to leverage and grow our property portfolio. The next thing to look at is your expenses. When leading up to making that property purchase, make sure you reduce your expenses as much as possible in the 6 months leading up to your lending assessment. This will maximize your ability to borrow money and improve your serviceability when it comes to their calculations. Finally, have a chat with lots of brokers and banks. When I chat to people each week in my free strategy sessions, I hear a lot about people struggling with the broker that they're working with. The broker said I could potentially get access to $800K and now it's $600K. Or I wanted $1 million and now it's $700,000. Things are always changing when it comes to lending. So make sure you have chats with multiple brokers and multiple banks. When Emily and I started and grew our multi-million dollar portfolio, it was one property at a time. And we did a few different things. We added value through cosmetic renovation. We also saw the market appreciate. We also increased our day job incomes as we were getting promotions. And so those multiple factors allowed us to leverage our cash, leverage our equity, pull out equity, and subsequently use that money for deposits on future property purchases. So if you've had chats with lots of brokers and lots of banks who are very readily known, like the ANZs, the Westpacs, the CBAs, and so on, then maybe look at some second-tier lenders or even some third-tier non-APRA regulated lenders. Now, you need to obviously carefully assess the loan products that you're signing up for, but if you're willing to pay a slight premium in terms of interest rate, then you can get access to a lot more cash. For example, CBA might lend you, say, $600,000, but if you have a chat with Pepper Money, they might lend you $1 million at a 1% higher interest rate. So you need to weigh up for you whether you want that $1 million of lending capacity or whether you're happy with the $600,000 of lending capacity at the slightly lower interest rate. The way I like to look at our portfolio is a weighted average interest rate across the portfolio. Now that's enough on tip number 1. That was a big tip, which was going around serviceability and how you can get access to more cash from the banks. It's so important because it allows you to access more debt, which allows you to control more assets, and over time, assets compound year on year. And that's where you create that large amount of equity, which you can then turn into cash flow. Now, speaking of cash flow, this leads me into number 2, which is using offset accounts for your excess cash. The way Emily and I manage our bank accounts is through having an offset account with a variable rate against our own home. And our other rates could be fixed, they could be variable. We don't mind, it depends on the situation. But when it comes to having an offset account, you generally want an offset account against your own home or your highest interest debt in your property portfolio. The reason we want the offset account against our own home is because our own home is non-deductible for tax purposes. So when we're making interest repayments back to the bank for our own home, we can't claim those interest deductions at the end of the financial year in our tax returns. So parking money in our offset account means we're reducing our non-deductible debt. Now, there might be situations where if the interest rates are significantly different between your own home and an investment property, you might want to park your funds in your investment property's offset account. If that interest rate was at 10% and your own home was at 2%, that's where it would probably make sense. So you've got to weigh up, but definitely use the power of an offset account to keep yourself liquid and don't give any extra money to the banks that you don't need to. When I hear of people paying down their mortgages or paying down their loans, I don't quite always understand it because I would always want to keep myself liquid and put as much money in my offset account rather than paying down the loan. It essentially works in the same way, but gives me the liquidity. Now, tip number 3 is going to be a very hard truth for a lot of you watching on YouTube, and that is that Emily and I have added value to our properties through renovations, and we've done a lot of those as DIY. Now, Cherie Barber is probably the godfather, as I'd like to say, or the queen of renovating here in Australia when it comes to doing cosmetic renovations for profit. Growing up as a teenager, I used to watch my parents watch Cherie Barber, and my parents are not the best renovators. Hopefully they don't watch this video. But when it comes to adding value to property, renovation has been one of the key strategies that Emily and I have used to grow and build our property portfolio. Now, this is not for everyone, but if you want to fast track your journey and you want to add value and pull out equity sooner, then renovating can be one of the best ways to do that. You're not reliant on the market slowly appreciating over time or chasing hotspot suburbs where you want other investors or other homeowners to come into that suburb and pay more for property. When you're buying a renovator, you're looking at the unrenovated properties and the renovated properties and looking at the cost it would take you to actually renovate an unrenovated home. If there's enough disparity between unrenovated and renovated, that's where you can take the opportunity to buy, renovate, and hold that property, refinance that equity, and go out and use that equity with another purchase. This is what Emily and I did on our first purchase. Our second purchase, which you can see the renovation series called the Baby Queenslander, the Triple Gable Queenslander, which is this place. There's also a renovation series. And so we've renovated every single property we've bought. We have a passion for renovating. I quite enjoy getting my hands dirty and getting stuck into a project, and buying, renovating, holding, and refinancing, or the BRRRR strategy, also known in the USA. Using that buy, renovate, refinance, and repeat strategy can really boost your property portfolio if you're looking to jump on the fast track. It is a lot of hard work though, that's the honest truth. So I won't lie to you in saying that there were a lot of late nights, a lot of weekends, a lot of sweat equity and hard work has gone into our property portfolio. But it creates that snowball effect. Once you can build that asset base, it builds on itself through compounding. So I would recommend, if you're looking to jump into renovations, look for something simple and cosmetic, which is just covering the basics. You just want to be doing paint, flooring, and at most kitchens and bathrooms. You don't want to be doing structural work because that's where it can get very expensive, and you want something with a short time frame because that will reduce the risk. So look for a cosmetic renovation if you're looking to fast track your journey. The next tip is to make sure you run your numbers. No property purchase is worth it without understanding the assets, the liabilities, your equity, and the income and expenses associated with that property purchase. If you don't understand all of the income and all of the expenses and the cash flow that is likely to turn out from that property purchase you're going to make, then you don't really understand what you're getting into. I have a free property investment calculator on my website at purposeproperty.com.au, which you can download for free and punch in the numbers for your potential property purchase. This covers a lot of expenses when making a property purchase and can allow you to run a cash flow with different scenarios where you can play around with the rental income. You can look at $480 a week, $500 per week, $520 per week. It's important to look at low, medium, and high scenarios. I always like to run my cash flows on a worst case scenario, even if I might expect a median case or a higher case scenario to play out in reality. If I understand the worst case case scenario for my rent and the highest expenses associated with holding that property, then I can get comfortable with making that property purchase. So ensure you understand the numbers when it comes to purchasing property and do your due diligence before you make the purchase. It can come as a rude shock to many first-time investors or homeowners when they make a property purchase and they're hit with bill after bill. You get hit with your rates bill, your water bill, the electricity, the gas, the land tax, it goes on. And so once you've got those expenses listed out, you know exactly what you're up for and make sure you have buffers in place to deal with emergency situations. Now, to close this video out, my final tip is more philosophical. You are running your own property investing race. Whether you see my videos here on YouTube or other gurus or YouTubers revealing their portfolios and how quickly they did it, at the end of the day, you're running your own property journey and your own property race. I know people who have started in their early 40s and built a property portfolio over 20 years before they retired at 60. I know some younger people who have gotten into their first property purchase in their very early 20s or even in their late teens. Everybody is different and you're running your own race. One thing that Emily and I like to do is to give back. And so for every property purchase we've made, we've also sponsored a compassion child. And we'll continue to do that with every property purchase we make subsequently. This is because we want to give back. And property investing and building your assets and building your net worth is no good if you don't have a generous heart and you can't give back to other causes. We also like to donate 10% of my business's revenue to charity. We're looking to help areas in homelessness and affordable accommodation and clean drinking water. So whatever you're passionate about, also look to donate to those types of charities. There's no point looking for more and more expensive things. For me, it's about creating choices and having experiences with the people I love. I want to spend time playing football and going to the gym and going on holidays and also building my business. For me, financial freedom is not about retirement, it's about choices and flexibility. That means being able to take control of my calendar, say yes to things and say no to different things, but not get caught up in buying toys. There's a guy on YouTube called Matt Armstrong who does car refurbishments in the UK, and Em's telling me to stop looking at those fancy cars, stop looking at those Porsches and Mustangs and whatever else. And so shiny things are nice, but if you wanted to go have an experience, go rent a car on a track for a few $1,000s on the day. For me, a basic car and a roof over our head that fits our family is what we need going forward. There are going to be a few luxuries and perks along the way. We're looking to have a swimming pool with our raise and build and add a carport out the front and make sure I have a studio to shoot these videos in. So we are spending money in certain places. It's about having the heart and balance to give money away and also find the balance in what you spend your money on. So these have been some tips around being a property investor. We've covered a range of topics in today's video, and I hope you got value out of this video. If you could drop a like on this video and subscribe to the channel down below, that would really help me out. If you're looking to have a chat and potentially buy a property in the Brisbane market in the next 6 to 12 months, then head over to purposeproperty.com.au to book in a free strategy session with myself. We'll sit down, have a chat about your situation, your short and your long-term goals, and how we can potentially help you buy a property in the Southeast Queensland market sometime soon. Otherwise, click this video over here, and I'll see you in the next one. Peace.